Welcome to a session, another webinar from Sanlam Private Wealth. My name is Mark Muller. I am the director of Sanlam Private Wealth and Sanlam Private Wealth Guernsey. Very pleased to welcome you here. Today is Thursday, the 29th of May. I am coming to you from Cape Town in South Africa with our team in the background in Mauritius and Guernsey, pulling the strings for us, and with Arthur dialing in also from Cape Town in South Africa. Today we're going to be speaking about broadly Trump and tariffs, as the invitation said, and Arthur's going to unpack for us the turbulence and the mayhem, I would say, Arthur, perhaps that's the correct word, that has been unleashed by the election of Mr. Trump, and since January, and the rollout of his election promises, particularly regarding tariffs. We look forward to having your views on that. For those of you who have attended these calls before, Arthur will be no stranger to you, and we are very pleased to welcome him to this forum. And just Arthur's bio quickly. Prior to joining Sanlam Investments in 2005, Arthur worked as an economics consultant at Eskom from 1990 to 1995 rather, and thereafter spent 10 years working as an economist at stockbroking firm Simpson McKee and the global investment bank HSBC. During this time, he was responsible for HSBC's South African economics product offering. Arthur holds an honors in B Economics, cum laude degree from the University of Stellenbosch, and an MSc in financial economics from the University of London. Arthur, after that mouthful, I've set the tone and platform for you. Welcome to yet another session, and thank you, as always, Arthur, for being willing to share your insights and views. We look forward to this session as well. Just some housekeeping issues. We do have a Q&A scheduled for the end of Arthur's presentation, which is going to be about 25 minutes, and then we'll leave time for Q&A. So if you do have any questions, just pop it onto the Q&A screen. Alternatively, just unmute yourself and ask the question. Arthur, thank you very much, and it's a pleasure to have you presenting to us again.
Thank you very much, Mark. So hello, everybody. So Trump and tariffs. So what I'm going to try and do today is obviously talk about this topic because it's what's around us at the moment and is impacting our markets on a daily basis. But I think more important as investors, we need to just step back, and I think we need to put this in the context of what global shifts are taking place that are affecting the investment environment. And I'm going to try and bring across to you how we think about that here from both an economic perspective, and then what it implies for currencies, interest rates, and how that then feeds through into the way that we view investments, because there's big, broad themes at play here. Trump's tariffs are one aspect of that. In part, it's a kind of acceleration of themes that had already been underway previously. But let's first talk about the tariffs. Early April, things looked really shaky. They're still not looking great, but it was really concerning with the reciprocal tariffs announced, and some of those were really, really high, as you know. Also across our continent, very high tariffs, even on South Africa. And effectively at that point, if you added in 145% tariff on China, you were looking at a US effective total tariff of around 25%. And subsequently, that's come back because the reciprocal tariffs have been shifted out, or there's negotiations, and we'll see how many of those are implemented or whether they're implemented in full or not. Then at the same time, we shifted down to sort of baseline tariffs with a range of countries at 10%. And then the temporary deal, and I stress the word temporary, so in this environment, a lot of what we're seeing is temporary and can change at any time. But the temporary deal with China that brought back the tariff from 145% to around about effectively 40% for China, which is still a 30% increase, incidentally, from where they were previously. But at least that then brought down the total effective tariff to around 14.5%, thereabouts by my calculations, and then that made everyone feel a little bit better. So the market settled down. One market that hasn't quite settled down is the bond market, and we're going to get back to that because that's interest rates, and the US is the global risk-free interest rate. We all benchmark off that. It has implications across the globe for asset prices. So we're going to talk about that as well today. But at 14.5%, we're breathing a sigh of relief, but I thought I'd put it in this perspective. This chart goes back to 1821. And you can see that that 14.5% is still the highest level since the 1940s. So it is quite a jump still, and is going to have an impact on mostly the US economy, but obviously around the world as well. We'll talk a little bit about that in the next few slides. I would like to mention, though, that this environment is very volatile. And one thing that we do need to watch is the guardrails in the US. There are lots of them. Congress is one, and they haven't necessarily come to the party yet. Another one, though, is courts. And we saw the court decision, I think it was probably late yesterday, whereby some of the legality of President Trump's tariffs have been called into question. And we'll wait and see where that goes. Of course, he will appeal to the appeals court, and it could go all the way to the Supreme Court. So this is by no means over. But it is one of the guardrails that can kick in it's all about how much can Congress, how much of the authority can Congress on this issue cede to the president or not. So we'll watch that. But for now, let's work with our 14.5%. Of course, the other guardrails are the markets, and particularly the bond market. And I do want to talk about that a bit today, or the treasury market. And then, of course, the other one being voters. And we've got the midterm elections in November next year. So those guardrails could kick in and start bringing back some of the policies that are really doing a lot of damage. But I said tariffs are one thing within a broader theme that's unfolding, and we've been following this theme for quite a while, and that theme is growing global protectionism, and along with that, sustained loose fiscal policies for too long, in particular in developed markets, and the inflation risks that those two developments hold. And of course, if you talk about inflation, that's important, because that is important for determining the outlook for real asset prices. So bottom line, though, is what we have is a US that, for decades you had presidents going out into the world and promoting democracy and free trade and fair play and integration and globalization, because they saw that, or they of the view that if you manage to promote that in the world, and you manage to improve living standards around the world, then the US itself would be safer. And of course, this view is now being challenged quite clearly under President Trump. We'll have to wait and see whether it's a permanent shift in the US or whether it reverts again under a following president or not. But there is this shift, and they're clearly not feeling safe, and they're more concerned about security. And we've got a now much more inward-looking US, wanting to rely much more on its own energy. And then in particular, and I'll get back to this point, repositioning itself in a world where you've got this geo-economic fragmentation going on. But what I'm talking about is this rise in protectionism is quite significant. The middle chart shows you the share of exports in world GDP. And you can see that sharp acceleration there from well below 20% in the mid-1980s to about 30% of global GDP. And that was during the period that China joined the World Trade Organization, and we had the promotion of free trade and the lowering of tariff barriers around the world. Now, what does that do? What that does is it increases competition, and when you increase competition, you increase efficiency, and when you increase efficiency, you get higher growth and lower inflation. And that's what we saw around the world for a good long period of time. And then the global financial crisis came and the pandemic. And then you can see on the left-hand chart that number of global trade restrictions started to rise quite substantially across the board. Services, goods, investments. We're talking about thousands of global trade restrictions being implemented. And the flip side of that is you're reversing that process of efficiency that I talked about. And you're ending up with, and what that does, in my opinion, and you can see it starting to pan through in the numbers, right-hand chart, slower global trend growth and global inflation bottoming out after a good couple of decades of very low global inflation. And that, again, as I say, feeds back into asset allocation decisions, and we'll talk a little bit about that. But this actually, I made the point that we'll have to wait and see whether this outdates President Trump or not, but I would like to make the point that this actually precedes his current presidency. It gained some momentum under his first presidency, but it didn't stop under President Biden. And under President Biden, you saw particularly important development was the introduction of two acts, the Inflation Reduction Act and the CHIPS Act. Now, the Inflation Reduction Act was designed to give incentives for green technology development and for manufacturing of green technologies back in the US, and the funding of climate change initiatives. And you can see the boom that it gave to manufacturing production and manufacturing construction during that period. And then the CHIPS Act, and this was more, I think, along the lines of a response to geoeconomic fragmentation, because you had looked around the globe, where's your biggest manufacturer of semiconductors? And semiconductors in today's modern world with AI and computers is critical component, microchips. And so with China and Taiwan, with their relationship coming under strain, clearly the US then, I guess, was looking at this and saying, we need to make sure we've got secure supply. And so the CHIPS Act was designed to bring manufacturing of semiconductors back to the US. And you can see there, the black line is all US industrial production, excluding the production of computers and communication equipment. And it's the latter one is the blue line. And look at that sharp acceleration. So in other words, we already had this response to geoeconomic fragmentation and more inward-looking development in the US. But let's get back to our tariffs, because this is a bit of a near-term shakeup. At least when we looked at early April, we were, if you looked at the situation as is, with a 25% effective tariff, you were looking at a stagflationary scenario with a more than 50% possibility of a recession and high inflation, which is the worst position for the Federal Reserve to be in. And obviously that then results in a knock-on effect, because now we're all trying to figure out what the Federal Reserve is going to do, because we all benchmark off US interest rates. But at least now recession probability is receded. I'll show you in a second. We'll still probably have an inflation impact, though, and that will still therefore be important. Now, this is the one-year forward inflation expectations of the University of Michigan survey of consumers in the US. And, as luck would have it, this presentation comes just after the release of the May data. So you can take that last data point there, and actually you can put 7.3% in its place, which means this is the highest one-year forward inflation expectations amongst consumers since the early 1980s. So if consumers expect inflation, they do try and obviously feed that back into their wage demands. And then, ultimately, though, I think also it's reasonable to expect if you've got these type of tariff increases, you can work through the math. I would think that there's going to be a significant inflation impact. Possibly measures of core CPI in the US could get to about 4% for a month or two or so in the latter half of the year, which is quite significant. But at least the probability of recession is not quite above 50 anymore. It's come back down now. You can see it went to 50 and then has come back down to about 36% at the moment. So it doesn't mean that there definitely will not be a recession, but I think the chances have receded. The reason that's done that is because of the recovery in the equity market. When you had the height of these tariff announcements and you had markets falling and you had all this concern about the sentiment shock, well, what does the sentiment shock do? It makes businesses think, well, we have no clear line of sight where we're going here. We're going to pull in our capex plans. We're not going to hire more labor. And then that actually drives the recession. But now what you've had is something of a reprieve on that. And importantly as well, the recovery in the equity market is very important from another perspective. In recent years, the US economy has been driven by consumers. And look at the right-hand chart here. US households' net worth, that's the black line. Look how that's been going up, supported by equity, obviously equity prices in recent years. And at the same time, they've been deleveraging. So they've been in a good space. Their net wealth has been up. And if you're feeling wealthy, then you don't feel the need to save. And you can see the middle chart there, how low that savings rate is compared to history going back to 1954. And you feel you can consume. You don't have to save. You're wealthy. And so, and that's a specifically important support for the market. So for now, that has settled down, but I still think that the economy is going to slow down. We mustn't forget real interest rates are still at this point significantly high, although obviously that must now be adjusted for higher inflation going forward. And this tariff shock itself is significant because the US, after you've had some, the producer, the exporter absorbs some margin, but then, at the end of the day, the US importer must pay that tariff. If he pays that tariff, he's got less to pay his suppliers, he's got less to pay his workers. And in an environment like that, with inflation going higher, it's not that easy just for workers to demand higher wages because they're a bit more worried about employment. And if that's the case, then the economy starts to slow down quite significantly. So it is a supply type of shock and has negative implications. Now, the impact on the rest of the world is more difficult to figure out. We've got the US economy slowing quite materially from an initial baseline at the beginning of the year, 2.1% to 1.3% this year. As I say, this is a moving target, and these will change quite regularly as the tariff announcements change. But on the rest of the world, yes, there will be an impact. I think one mustn't sit back and say, well, this is all going to be skewed to the US and nowhere else. It is nonetheless fair to say that it's likely that it will be relatively more impactful on the US than the rest of the world. Look at the right-hand chart, which is the share of US exports in total world exports. It's not the highest percentage of total global exports. Perhaps supply chain disruptions are not going to be as acute. If you look at machinery and those types of products, China is a net exporter. Very few net exporters in the world, and China is one of the main ones. And what you could rather see here is that to the extent that if you do not, for a 30% increase in tariff on China, could result in a 30% drop in exports from China into the US. What does China do with the surplus products? It could distribute it relatively more cheaply in the rest of the world. Of course, that will have to come along with, you can't go dump it on the rest of the world, and those is something to think about. But it's more likely to be a bit of a disinflationary impulse everywhere else as there's surplus capacity, as opposed to like the US, where you get this inflationary impulse. Also on our continent, left-hand chart, it really matters what happens in China and the euro area to us. And the euro area, if it moves more towards a genuine single market, and we have the additional spending that we are now likely to see, for example, in Germany on infrastructure, and unfortunately, yes, military as well. One doesn't like to see that, but it is going to be a significant source of demand and potential growth. Then, if Europe holds up and China, we're thinking about 4.5% this year, you'll probably see that the previous stimulus program announced already going to be brought forward. They might not need additional stimulus after this bit of a reprieve we had with the temporary deal. But we would expect that macroeconomic policy levers will be pulled there. Relative to the US, which is a relatively small trading partner, not an unimportant one, but a relative to China and Euro, a small trading partner for Africa. So when we look at the overall impact on GDP on our continent, it's not that big. Now, this looks quite big for South Africa, Mauritius, and Cote d'Ivoire, but just to be clear here, this is not what we are currently faced with. What I've done here is sort of sketched a first round worst case scenario where you have the reciprocal tariffs implemented as initially announced. Now, we don't think that that'll happen for all countries, or won't be as large as what was initially announced, but let's just say for a worst case first round impact. And some countries there are, nearly minus 1% of growth is material. But as I say, I don't think it will necessarily be this big. And also what this is really reflecting for these countries is the very high level of reciprocal tariffs. And already on South Africa, we're starting to see the potential for deals being done on the trade front. We saw the recent meeting that could scale this back. But you can look at the rest of the continent. The impact is not that big. And especially for economies that are growing pretty fast, this is not the biggest impact. So not unimportant, but first round impact's not that big. The more important thing is going to be knock-on effects from, for example, tightening of global financial conditions. And at the moment, what we're seeing actually is, rather in previous episodes, you would have thought the dollar is going to strengthen here in this environment. It didn't do that and took a lot of pressure off. And we'll get back to interest rates as well. Those, and then the other one would be, I'll come back to it in a second, commodity prices. Those would be more secondary linkages that could do more damage, but we'll discuss those. Just to bring us back to the point is we're focusing on these cyclical issues. We're trying to figure out what the near-term impact is going to be, but it's an environment which is going to be changing often, and we're going to be seeing lots of changes in forecasts. And we always bring ourselves back to long-term trends that are unfolding. And on our continent, and I'm not going to take all the countries here, but a number of our countries, and we've done this exercise a few times, this is our assessment of potential growth in these economies, based on a number of factors, like the base that you're coming off. If you come off a low base, you tend to grow fast, but other factors like human capital development, and then also institutional development, macroeconomic policies, and all of those things we put into this assessment. And West Africa, East Africa has maintained and is expected to maintain fairly firm growth rates. You'll see the growth rates where it's less exciting is the resource producers. And typically when resource prices turn down, resource producers do poorly. When resource prices turn up, vice versa. And that really is where the potential impact from the US is going to be concentrated. Look at the left-hand chart here. This was, if you look at post-global financial crisis, for example, big event. You saw a drop in commodity prices. So I've got the oil prices there, the black line, the blue line, metals prices. And you can see there was an impact on sub-Saharan African GDP across our continent. Then a rebound in commodity prices, growth rebounded, but then you had the big fall in commodity prices after, right through until the war broke out between Russia and Ukraine. And during that period, the terms of trade of resource producers turned negative or turned down, and that had a huge drag on growth on our continent. So resource prices will be quite important. What you're seeing in this environment is, interestingly, two things are standing out at the moment. One is gold. We're going to get back to that with South Africa. The other one is oil. Oil at this point is a bit of a negative for countries like Nigeria, Angola, in West Africa. So that could be something of a drag. And then also, unfortunately, a lot of these countries do not have a lot of fiscal space at this point. And although, so they don't really have the ability to loosen policy from a fiscal perspective to buoy growth. And so that if you get too many of the second round impacts coming through on the commodity side, that might become a bit of an issue. And I think maybe depending on how far the oil price goes down or not, Nigeria and Angola, for example, but very little fiscal space, unfortunately. So that is something on our continent. And what this does mean is that you'll probably find that fiscal consolidation is somewhat delayed across the African continent. Look at South Africa there. Debt ratio now climbing towards 80% of GDP, still a large budget deficit. Expected to peak by the Treasury at 77.4 in this fiscal year. Something of a worry, though, because there's no doubting the intent of our fiscal authorities to put the primary budget surplus in place that you need to lower the debt ratio. But the track record is poor, and we do need an improved track record there to be more confident. And for an improved track record, it's related directly to growth. Growth in South Africa has to lift. That's a whole different topic. So if there's going to be cyclical vulnerability or cyclical inverted commas to the situation in the US, it'll come through in these forms: commodity prices, not enough fiscal room. But for now, with these sort of baseline tariffs and what we discussed is the bit of a reprieve on where tariffs are, watch the guardrails as well, probably a manageable situation. So this is what happened typically I could show you a number of countries here. I've just picked these, but the pattern has been quite similar in many of them. When the tariff war initially gained a lot of momentum early April, we saw CDS spreads, that's a spread on foreign currency debt of these countries, jump. But you can see there not nearly as much as what we saw when the US was hiking interest rates. Remember, I said the Fed matters. US interest rates matter for the rest of the world. And also during the taper tantrum during sort of 2013 as well in the US. So, and also subsequently, what you'll see in more recent couple of weeks is that these spreads have in fact come back down again. But as always, you got to look at each country carefully. Senegal, a bit of a different story. Yes, that spread has come back after blowing out a little bit during the when the tariff war escalated. But there's a fiscal situation that's quite concerning there, and it's a more structural trend. But overall, you're not seeing the typical sustained rise in CDS spreads. As I say, many of these have now come back that you find typically in an environment like this, or where there's a concern about risk that would then feed through into emerging markets, local interest rates and currencies. But now, I said the one thing that's very different in this environment from what you would have expected is lots of global uncertainty. Flight to quality is what you're normally looking at. You're not seeing it this time. And the US dollar has been significantly weakened this year. I'd like to stress, I don't think that the dollar is going to keep weakening in a straight line. I do think that there are question marks behind the dollar as reserve currency. And I think it's those question marks that's led to some of this near-term weakness. Now, you may have heard people talk about the incentive to weaken the dollar. There are members of the President Trump's administration who think it would be a good idea to weaken the dollar. Why would you want to do that? You would argue that a weaker dollar would correct these trade imbalances. Now, I said that the US was becoming more inward-looking. And of course, one of the issues around that is that President Trump really does not like trade deficits because it's like you're reliant on the rest of the world. And particularly for important strategic type of imports, you feel you're being unfairly treated. It's not a level playing field. But you need to flip that argument on its head, really. But before I do that, in the 1980s, mid-1980s, we had a very similar situation. Wide current account deficit in the US, reflecting a large trade deficit. And particularly with countries like Germany and Japan. And what we had at that time was then the Plaza Accord, which was an agreement. And US went to Japan, Germany, and sort of indicated them, look, you're not treating us fairly. We're going to retaliate here, whatever means, whether it's tariffs, and we would like you to cause your currency to appreciate. We want a weaker dollar because we want to improve this current account situation. And that's what happened. We had a pretty strong appreciation of the Deutschmark and of the Japanese yen and weakening of the dollar. And that went along with the current account there. You can see it actually closed back towards 0% of GDP. However, one very important thing is that it also coincided with what was called the Graham-Rudman-Hollings Act at the time, which was a fiscal consolidation. Because at the end of the day, and I said, let's flip this on its head, the current account deficit in the US is a reflection of the capital inflows which a reserve currency attracts. Those capital inflows have gone, a lot of it's gone into the treasury market. What is the treasury market doing? It's funding the government. So it's funding loose fiscal policy in the US. And so if you're going to force the current account balance to close, it implies on the other side less net capital inflows. And that obviously then implies that, well, someone's then got to save more. And if it's not going to be the private sector, then it better be the government. And you need a fiscal consolidation. Now, that's not what we're seeing at the moment. What we're seeing at the moment, and I'll talk about that in a couple of slides' time when we finish off, because it's very important for interest rates, is we've got legislation in front of that's been passed by the House that's going to the Senate that actually increases the budget deficit going forward. So this is not adding up here at this point. But the incentive is there to do something about the real trade weighted dollar. And you will have been hearing about all of these possibilities. Now, we don't know if they will be implemented or not. One of them would be you don't allow countries to hold your assets. So you have, for example, like sanctions that you have in Russia. Or you would threaten countries with tariffs, assuming the checks and balances allow you in the US. And you sort of strong arm other countries into weakening, or beg your pardon, appreciating their currencies and allowing the dollar to weaken. Or you've even got some ideas around taking US treasuries and then swapping, if you're a foreign holder of a US treasury, swapping your holding into a perpetual bond or a zero coupon bond, which is effectively extracting a user fee from you. So that'll discourage you from buying those treasuries. Or even using quantitative easing to keep interest rates low, in which case that also then weakens the dollar. So there's all of these things being bandied around. But one thing that is clear, right-hand chart, real traded weighted dollar is really strong. So the incentive is there. Will it happen or not? I don't know. I would wonder if the risk of that goes up if the president can't implement tariffs to the extent that he wants. And we can see from this chart, it really had a big impact in 1985. Look, the Deutschmark went from not too far of 350 to the dollar to close to 150 to the dollar in a couple of years. And that's a really big move. Right. But in terms of the US currency, and I spoke about, this question mark behind the US as the world's reserve currency. So I thought about this and I made a little list about what would I think is a worthy custodian of a reserve currency. And a worthy custodian of a reserve currency, you would have to have full convertibility. You have to have strong institutions. The US has got full convertibility. That's not easily available anywhere else. It's not available in China. In Europe, it's too fragmented. You need a fiscal union, a proper fiscal union functioning there, single market. So there's not a natural alternative at the moment. Strong institutions, well, I think the US does have strong institutions. They are being tested at the moment on these tariffs, for example, and you are seeing the federal courts coming up now and saying, hang on, we need to look at this and starting to potentially curtail some of these policies. So, potentially that question mark could become a tick again. But sound fiscal policy, it's a no for me. Get back to that in a second. Promotion of free trade, that's a no for me. The US has got full right to demand to be equally treated, but I think these kind of tariffs that were announced in the way that they were announced and put together, I don't think that qualifies as an argument for promoting free trade. Respect for international law and sovereignty of states. So one of the things that the US wants to secure, of course, is strategic supply of minerals and metals. And we've got these, I don't know how real they are, I can't judge, but you're talking about Canada and you're talking about Greenland. It's not quite what you want to see. So there's a question mark there, perhaps even a cross. and an independent central bank. That's critical for reserve currency. Now, you still have an independent central bank in the US, so that's a tick. So it's not a slam dunk that we're moving away from the US as reserve currency, but there are question marks around that potentially happening. What is and what you are likely to see, in my opinion, is over time less capital inflows into the US than previously, and perhaps a longer term depreciation of the US, but quite a slow process. If it were to be a quicker process, that would be much more problematic, create a lot of market volatility, and would come with a lot of possible negative outcomes. If you're in a situation where you've got a major event, global financial crisis, and you're looking for a safe asset, and suddenly there's not really a safe asset anymore, then you find countries starting to implement capital controls, etc. So I'm not saying these are going to happen, but I think what we need to understand as investors is that we are in an environment where the potential for alternative policies that we're not used to, different types of policies, that the risk of those being implemented is somewhat higher than previous. Just to illustrate this on the Rand, we thought the Rand would weaken quite substantially in this tariff environment. Initially it did, but it's now come back a long way. Why has it come back a long way? Well, on the one hand, the Rand has been pretty weak for quite a few years now. In terms of trade, lower commodity prices, interest rate differential with the US, supply side problems back home, infrastructure constraining growth, and then also volatility from time to time in global markets. And the VIX is one of the explanatory variables for our model here, and this model tracks our currency quite nicely. But it's come back quite a bit now. This model runs up to the end of the first quarter because it uses terms of trade data, which only comes out quarterly. It's come back quite a long way because of, one, the dollar's been weakening, but secondly, look at the right-hand chart. One of the beneficiaries that would seem to me from this uncertainty around the dollar has been the gold price. And gold is pretty finite. Well, it's not in the ground, but ultimately it's a finite resource. And, the spike in the gold price relative to the sharp fall in the oil price for a country like South Africa is just perfect, because that means that our terms of trade and our purchasing power have gone up very strongly, and that's gone along with a stronger Rand. So, from here, a lot will depend on, as I say, do we have a near-term sharp fall in the dollar or more sustained long-term decline? If it starts to lose its luster as reserve currency, I think it's probably the latter, with bouts of quite significant stability in between. But for now, certain countries could benefit from this type of terms of trade improvement. I'm going to go through this very quickly. It's not the case for all currencies, of course. We track currencies quite carefully. You have to look at each currency quite carefully. The Naira has already depreciated a long way, for example, before any of these events, and is undervalued. And as far as the Egyptian pound goes, a lot of capital inflows, FDI inflows, multilateral development institutions or multilateral financial institutions support long-term fiscal problems, though. Same with Kenya, good capital inflows at the moment, low inflation, reasonable real interest rates, but fiscal problem longer term. So a lot of currencies at the moment, we're not seeing this sharp fallout in currencies that you typically see amongst emerging markets, including those on our continent. And that's a lot of that's got to do with the dollar weakness. Some of these countries benefiting, not these on this page, perhaps Egypt to some extent on the gold price, but it would be losing on the oil price side. So each country is going to have its set of circumstances, but on our continent anyway, a lot of currencies are fixed, West Africa, and some are managed. So at this point, we're not seeing this big fallout with really higher interest rates and weakening currencies because of what's happening in the US. But the Fed still matters. Just plotted the Fed funds target rate here versus South Africa. Not exactly one for one, of course, in terms of movement, but in terms of timing and direction, I think it's fairly clear. And this is true for a lot of emerging market countries. And to finish off the presentation, so the Fed's got a lot to think about. And the previous slide shows we benchmark off the Fed. So this is one of our broader themes that we've been looking at in recent years. And that is, not just the US, but loose fiscal policy in developed markets more generally. But of course, the US is the point where we start because that's the benchmark interest rate for the world, risk-free interest rate. And this is important for the Fed ultimately as well. Now, the Fed's going to be more concerned about inflation near term, perhaps with the growth risk dissipating to some extent. It's got to worry a little bit more about inflation, so it's going to delay potential further interest rate cuts to later this year. So that's important. But also, when fiscal policy is too loose for too long, there's one significant risk from it, and that's higher inflation. I used to work with an economist, Roger Bootle, who wrote the book The Death of Inflation decades ago. And in that book, how he highlighted how inflation episodes around the world are very often linked to unsustainable fiscal policies. Now, I'm not saying by any stretch of the imagination that the US is about on the brink of a fiscal collapse and spike in inflation because of this. However, we are moving in the wrong direction, and we have to take note of it. And in part, I wouldn't be surprised if this starts to feature, if not directly, but at least indirectly into Fed interest rate decisions. The big change is the left-hand chart there, real interest rates, and this is important for assets across emerging markets, is that real interest rates in the US went from 0 to negative to significantly positive. At the same time, we've got this bill that I talked about earlier, approved by the House, Senate. We'll have to wait and see. But effectively, it adds $3 trillion of debt potentially to the US over the next 10 years. 2.3 trillion directly because of the extension of previous tax cuts implemented during the first President Trump's presidency. Also, some expenditure cuts as well. It's partly paid for by import tariffs, although the collection there is going to be significantly less than expected once you worked all the indirect effects through. So 2.3 trillion, but then you've got, obviously, you're borrowing and you're paying interest on that. And so you get to this 3 trillion, and the Congressional Budget Office apparently talking about going from close to 100% of GDP debt to over 125% of GDP debt. Now, my chart there on the right-hand side is from the IMF. It's for the general government, whereas the CBO is talking about the federal government. But you can see, essentially, we're talking about the highest levels of debt since the Second World War. And then the very important chart is that middle one, interest payments to federal revenue going up quite sharply. We've got a quarter, I think it's $9 trillion or thereabouts of US debt being rolled over this year. We've got a 6.4% federal budget deficit last year, likely wider deficit going forward if this bill goes through and becomes legislation. And this rising debt ratio. And this is one of the most significant changes impacting, in the last slide, real interest rates around the globe. We benchmark off the US. I've mentioned that a few times, but it is a critical point. And what we're seeing is globally, we're seeing the bottoming of what has been a long-term structural decline in US interest rates and developed market interest rates. So this chart goes back to 1915, and you can see there during the 1980s, when the yields peaked, very high inflation during that period, and has subsequently come down through to the pandemic, and since then has begun to move higher. So if you take the Fed's 2% inflation target and you've got 4% bond yield or 4.5% treasury yield in the US, you've got a 2.5% real yield. That is substantially more than the 0 to negative real interest rates that we had before. And I'm not going to go through it all now, but there are structural forces that drove those interest rates down. They include demographics with the savings glut that Ben Bernanke used to talk about, former chair of the Fed. Inequality, wealthier people tend to save more. All of those factors push down interest rates. At the same time, slower productivity growth in developed markets, lower returns on capital, less investment, downward pressure on interest rates. Cost of capital goods relative to consumption goods had been in a long-term decline. That put downward pressure on interest rates. The one factor that had been putting upward pressure on interest rates was government debt rising, but it hadn't risen enough. But what we've seen in recent years is the extent of this fiscal looseness, and now extending it further going forward, potentially, we're starting to see this, in my opinion, become a more dominant factor. Plus, over time, you can expect demographics to start turning the other way again, particularly important factor. So you're sitting with a higher global risk-free interest rate. And obviously that then feeds through into the valuation of other assets. Just to finish off, how do we think about this? So the decision we have to make as investors at the moment is the following. How does this pan out? One, do we get higher inflation in the system because of all this protectionism, fiscal policy being unsustainable long term, but you allow inflation in the system as authorities because that erodes the real value of your debt, which is what you want, which was what policymakers may want? Or do you have the central bank standing firm and saying, no, we're going to maintain low inflation, but for that we need higher real interest rates for a fairly long period of time to get that inflation back down, to dampen growth sufficiently to get inflation back down. So that's the decision that we're sitting with. What we have done is you've started to see it in our own assessment of South African yields. We've started to price in, well, first of all, in the US, a higher real yield on cash. We have previously, before this, we were working with a 0% real cash yield in the US. Now we're working with 75 basis points to 1%. Add in a risk premium for South Africa. So that already is a knock-on effect onto South African interest rates. And so, this is a significant change that we have to be aware of, along with, as I say, the potential long-term weakening of the dollar and what that also then implies. So I'm going to leave it there. I hope I haven't gone on too long. I suspect I may have. But I'm hoping that I can answer any questions you may have. And I'll end it there. Hopefully there were some points there that you could extract and found useful.
I appreciate that. I wonder if you wouldn't mind sharing your screen so we can see you slightly bigger, Arthur. And just one question came through, or message came through. If you can just sit a bit closer to the laptop, it seems that your sound was quite soft. Arthur, a couple of questions have come through. I'm going to, from our Mauritius office, we've got our senior wealth advisor that's got a question. And so, Anne, if you want to just go ahead and ask Arthur the question that you have, please.
Thank you, Mark. Thank you, Arthur, for the presentation. I have so many questions, but I'll try to narrow it down to just the one question that I have. So you highlight in your presentation rising inflation expectations and an increase in the probability of a recession in the US. If this trend continues and we see greater macroeconomic divergence between the US and the rest of the world, how do you see this impacting capital flows both in the US and perhaps more closer to home in emerging markets? And in your opinion, are there particular regions or sectors that might stand to benefit from this environment?
And thanks very much for those questions. So I think that the negative impact of this is more skewed towards the US because, as a starting point, the rest of the world, a lot of countries, they have 2% of their total exports to the US being affected, whereas the US has all of its imports being affected. And at the same time, combining it with now on fiscal policy, there's another view that I must express, and that is that people within President Trump's administration are arguing, look, we're going to deregulate and we're going to cut taxes and we're going to grow the economy at 3% and the debt problem is going to go away. But I don't, the problem here, of course, is you've seen immediately the backing up of US Treasury yields, and in backing up those US Treasury yields, that's indicating that there's a potential issue here. And of course, in the US, a lot of debt is typically priced off long-term interest rates. So, I don't. It's an alternative view, but I don't buy into it. And I do think that on margin, what you're seeing here is essentially a rise in protectionism means a worsening trade-off for the US between inflation and growth. There are things that I could be wrong if, for example, AI generates so much productivity that none of this really matters. But I'm not in that grouping. I agree. I think the capital inflows into the US slow down, and already in recent years, China, its holdings of US Treasuries has been declining quite significantly. We saw reports where Japan, in these trade negotiations between the US, actually brought up the point that, look, we hold over $1 trillion of your treasuries. I don't think that this necessarily leads to selling of US assets. But what it would do is, I think most countries would look at this and say, look, in future, we'll still buy US assets, but not to the same extent as before. So we'll put less money into the US. Your challenge then is to figure out what you're going to put it into. And that's the thing at the moment. There's no natural alternative to the dollar right now. So you've had money flowing into gold and you've had money flowing into Swiss franc. But if you look at Switzerland, that market it's too small to sort of act as a world reserve currency. Gold is finite, so I think it's unlikely we see this big wholesale swing away from the dollar near term. But you do find, I think, investors looking for alternatives. What is the potential alternative? I think the potential alternative is Europe, not just Europe, but Europe, if it does a couple of things. One is, Germany has done a bit of a sea change in the way that it looks at things with its infrastructure spending and spending on military. Not something I had considered before. Loosening budget rules to do it is an important development. At the same time, if Europe is a single market, but is it really? And I think it could do a lot more to become a more vibrant single market and drive growth. And you could be at the beginning of firmer growth in Europe, in which case it could over time start to attract more capital, act as something as an alternative. You're not putting everything into dollars, but you're starting to diversify into euros somewhat more. The other country that's very interesting in this environment is China. China, this is almost an ideal opportunity for China, in my opinion, to do what it knows it needs to do, and that is less reliance on exports to, for example, the US, and more reliance on domestic demand. And maybe some of that potentially surplus capacity, if you keep the tariff at effectively 40%, that's still a very big increase, and there's going to be surplus capacity, and try and get some of the capacity focused back on domestic consumption, get the domestic consumer going. So perhaps that actually starts to stimulate this process in China of more inward looking, or at least stimulating domestic demand in its own economy, which it needs to do. And also, I think it will encourage China, and we've seen this is the stance that they've taken, to be more open to trade agreements elsewhere. And, for the first time, a little while, not too long ago, you're seeing China and Japan at least talking to one another about trade. So I think that this could encourage free trade outside of so just because the US is putting up barriers, and globally we know the barriers are going up, it doesn't necessarily have to be everywhere. And China might strike a couple of trade deals. Capital flows into the rest of the world. So I can look at South Africa, for example, is traditionally, we are very reliant on capital inflows from the US in particular. As a single country, it's the largest. So Europe is very important as a bloc. But as a single country, the US stands out, particularly for foreign portfolio investment inflows. And some of that will come from the rest of the world through the US funds into South Africa. But I do think that increasingly we're going to see our investment needs being increasingly funded from elsewhere. And I think what we're seeing is a couple of the countries that are stepping into that space now are the GCC states, for example, where you're starting to see them more actively investing. And so a country like, I'm using South Africa because I'm comfortable with it, that's where I live. I think we're going to see a shift in that direction. I wouldn't be surprised. China becomes a bit more active on our African continent overall as well. So I think over time, I do hope that if we are seeing a structural decline in the dollar, this is my central view. It's not going to be a straight line, take time. I just hope it's not a sudden dislocation. A sudden dislocation would be very problematic because, firstly, if it's combined with, for example, a loose US fiscal policy, you could end up with QE to keep interest rates low in a very messy environment. Or secondly, if you are if you get a global financial crisis again, for example, where's the flight to safety? And those dollar swap lines that were available previously not available anymore. And then you're starting to try and you get capital controls being implemented. So it's a much more volatile, messy financial environment if the dollar were to suddenly lose its reserve currency status. I wouldn't make that my base case. I think there's a low probability of that. I think that what happens is that we have funds flowing less vigorously into the US while starting to diversify elsewhere, with Europe potentially as one of the beneficiaries.
Arthur, thank you. We've probably got time for one, maybe two more questions. I'm going to read you a question that's coming from Warren from our Mauritius office. Hello, Warren. I'm going to read it to you. It says, do you think AI could have a deflationary effect on the US economy, given that it is making certain jobs redundant? For example, Microsoft laid off 6,000 employees in Q1 2025. Good question.
Yeah, great question. And I wish I could give you a definitive answer. AI has done one thing, it's done a lot of things. But one thing that's different from the way that you normally manufacture is once you've developed software, very expensive to develop, but once you developed it, it's free to distribute. It's not like a car where you've always got costs associated. You're always cost cutting. You're always trying to be cheaper than the next guy on every step of the production process. Once, AI is free to distribute. And so you've got this and it lends itself, in my opinion, to this concentration of let's call it production in AI, which is disinflationary, deflationary in that sense. Once the software has been developed, the jobs that are going to get lost are, this is a whole topic, and it's so relevant for South Africa and for our for emerging markets as well. But emerging markets, unfortunately, are not as prepared as developed markets for AI. And in developed markets, you could see, and you're talking about fairly high skilled people that could be replaced, rather than your sort of semi-skilled person or your even lesser skilled people. And so that's going to create, I think, quite an interesting amount of tension. But at the same time, I don't want to overstate the extent to which AI is going to destroy jobs. At the same time, it's also going to create a lot of jobs within that industry. At the end of the day, even within energy, the amount of energy you need to run these things is enormous. We know renewables is very employment intensive. The manufacturing of what's required, all of that is still manufacturing. So I don't want to overplay it, but that's the scale of my knowledge. I'm as unclear as many people on this one as to exactly where we end up here. But yeah, I'd leave it at those comments. I don't know if they have any help at all, but I'd leave it there.
Yeah, thank you, Arthur. That was great, giving some insight into what is a very new area, and I guess the bounds of it are still to be defined. Last question from our MD in our Guernsey office, James. The floor is yours.
Thanks, Mark. I'm assuming you can hear me.
Yeah, loud and clear, James.
Cool. So, Arthur, thanks for, what has been a very interesting presentation and subsequent discussion. One of the things that fascinates me is I guess one of the points you made in your reserve currency commentary was the independence of the Reserve Bank, or in the case of the US, the Fed. And, what has been very interesting to me is the relationship between Trump and the Fed Chairman Powell, and I guess the pressure that President Trump is trying to place on the chairman to cut interest rates. And I guess he's probably wanting to do it before any potential inflationary effects of tariffs work their way into the numbers, would be kind of my assessment. And it puts them in quite a tricky position. And then you juxtapose it against the longer end of the curve where, I guess in an environment where the US still needs to fund their deficit and borrow substantial amounts of money in a changing kind of, I guess, capital flow backdrop, because a lot of their traditional buyers of long-term debt are actually sellers of long-term debt and reducing their holdings. So I guess my question is, how do you see that environment playing out with a potential now steepening of that yield curve, where there's pressure on the Fed and perhaps even the backdrop for the Fed to cut against rising longer bond yields, to incentivize people to buy that debt and to hold that debt, and that's typically going to be 10 to 30 years out, kind of on the curve. I'd just be interested in your in your thoughts on that one.
I think this is a critical point. We're seeing the investment banks, the large houses, starting to delay interest rate cuts to late this year and into next year. One of them, I saw one of the large investment banks saying no rate cuts this year, and I think it's for exactly the reason that you're mentioning. You've got growth probably slowing, but a steepening yield curve. So that's unusual, and it's exactly the problem that you're pointing out. Is it's very difficult for the Fed to cut a lot when the long end is going the other way because of fiscal concerns. And so, if you've got a president now, I think at this point, it's the Chairman Powell and the Fed FOMC are not going to respond to the president. They're going to, at this point, wait and see how things pan out. And their main concern will now be inflation. They can be a little less concerned about growth. It's still going to slow down, but they don't have to be as panicked. No, I didn't say they were panicking, but they don't have to be as concerned, perhaps, as they were when the market had cracked early April and sentiment had plunged. So the Fed might just, in this environment, wait. The chair can, the courts here, if they were to decide on this, would indicate that the chair can only be fired for cause. And in Jerome Powell's case, I think it's going to be very difficult to show that. So I don't think that he can be directly fired. And also, in any case, even if you did that, you'd have to go after quite a few members of the FOMC to meaningfully change overall policy in your favor. In other words, trying to force them to cut rates. But I've been thinking the out of left field thing here. So the way that this pans out is you have delayed interest rate cuts, and you probably have the Fed's autonomy holding. But the risk here is that you have an increasingly frustrated president on two fronts. One is for the point that you mentioned, he wants lower rates before you see any inflation. The second one is that if these courts, if his appeal and if he goes to the Supreme Court subsequently on tariffs and he loses that, where it seems to me, and I'm not a legal person, but it seems like he can implement tariffs where there is a serious trade deficit with another country or words to that effect for, I think it's 15% for 150 days, which can still do a lot of damage, but it's much more limiting than what he can do now because he's using it as a tool to get other concessions. And if he can't get his way on interest rates and he starts getting this curtailment of his tariff policies and the use of tariffs to get other policies pushed through, I wonder if that doesn't start to frustrate him and he starts to look at other levers that he can pull. One of those being, what can he do about the dollar, for example? So that is a risk of some instability in markets. But for now, I'm going to hang my hat on the Fed's going to hold the line here. But you make the critical observation. Markets a bit nervous, long end rising, difficult for the Fed to cut.
Thanks, Arthur.
We probably could. Sorry, James, after you.
No, I was just saying thanks to Arthur. That's a very clear and good explanation. I appreciate the input.
Yeah.
Thanks, James.
Indeed. Arthur, we've got a couple of other questions, but we've unfortunately run out of time. I will pass those on to you, and we perhaps can get back to those the people that have posted the questions. But thank you very much for joining us again, Arthur. If you do have questions that you want Arthur to answer, or if you do think of topics that you'd like us to speak on in future, please just email me, and we'll do the best we can to facilitate that happening. But Arthur, as always, most insightful, and appreciate your time. Thank you very much, everyone, for joining us. And that's all for now. Thank you very much.